Welcome, everyone, to a new deep dive from the Gap Advisors and Ask S Clinic podcasts. We are really excited to get into today's topic.
Yeah, absolutely. It's a really fascinating one today.
But before we jump into the analysis, I just need to emphasize that the views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on you, the listener.
Right. That is really important to keep in mind.
Yeah, we strongly urge you to seek the help of a qualified expert before taking or, refraining from taking any action based on the views we discuss here today.
Exactly. Because, I mean, the application of Indian accounting standards is just highly dependent on the specific facts and circumstances of each entity.
Yeah.
Navigating these frameworks requires really careful, individualized professional judgment.
It really does. And actually, that need for precise context-specific judgment is exactly where today's deep dive comes from. We are going to be examining a highly specific, complex scenario that we pulled directly from the massive issue repository hosted on gapadvisors.com.
Oh, yeah. That repository is, well, it's just an incredible resource for the financial community.
It really is. It currently hosts over 4,500 meticulously answered issues on INAS and Indian GAAP. I mean, we are looking at real situations that professionals actually encounter out in the field.
And the sheer scale of that repository, right, over 4,500 resolved issues, I think it highlights a really crucial reality about accounting standards.
Which is what, exactly?
Well, the written standard provides
Oh.
the framework, but the actual daily operations of businesses, they generate these infinite nuanced variations that the framework somehow has to accommodate.
Right. It's never as clean as the textbook makes it look.
Never. And what makes this resource so vital is how accessible it is. Any person can register on the website for free and submit their own specific issues regarding NDS and Indian GAAP.
Wait, anyone can just submit an issue.
Yeah, anyone.
Yeah.
And in return, they receive a detailed technical response delivered directly to the inbox of their registered email on godadvisors.com.
Wow, okay. I mean, if I put myself in the shoes of an auditor, the value of getting a direct-to-inbox response like that is just immediately apparent.
Oh, 100%.
Yeah.
Especially for auditors.
Because, when you are conducting an audit, especially when you are nearing the end of the reporting cycle and you encounter some highly irregular financial instrument or, say, a convoluted currency hedging strategy, you just cannot simply guess.
No, you absolutely cannot guess.
Right. The audit file requires definitive documentation detailing exactly how you addressed the application of IND AS. Having an authoritative response to point to, it just provides this necessary foundation for audit quality and compliance.
Yeah, it acts as this independent, rigorous sounding board. It allows an auditor or, a chief financial officer to move beyond just internal debates and actually secure external validation for their accounting treatments.
That makes total sense. And today's specific scenario was actually featured in the 226th edition of the Gap Advisors Task Weekly newsletter.
All right, yes.
This newsletter is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and it is published regularly on LinkedIn. And just to give you an idea of the consistency of this resource, over 230 editions have been published to date.
It is a massive body of work.
It really is. So our core mission today is to demystify hedge accounting under Indian accounting standards by really dissecting the scenario presented in that specific newsletter.
Let's dive right into it.
Okay, let us establish the facts first. An Indian company has a foreign trade payable. They owe a supplier exactly $1,000.
Okay, simple enough so far.
Right. And on the day this transaction occurs, the exchange rate is exactly 60 Indian rupees to $1.
So the liability is initially recorded at 60,000 rupees.
Exactly. Now, this payment is due in exactly 3 months. But to protect against the risk of the rupee depreciating against the dollar over those 3 months, the company goes ahead and purchases a 3-month forward contract for $1,000 from their bank.
Right. And we should also briefly overlay the standard reporting period onto the scenario, because that is going to matter a lot.
Oh, yeah. The reporting timeline is crucial.
Yeah. Under Indian business practices, the financial year runs from the 1st of April to the 31st of March.
Right.
And that 31st of March date is the critical measurement point. All assets and liabilities must be evaluated and reported based on their exact status at the close of business on that specific day.
Which I'm guessing will become the central point of friction in our accounting logic later on.
Oh, you have no idea. It changes everything.
Okay, let's unpack this. We have a straightforward payable and a protective forward contract. But how do we actually account for this without making a complete mess of our financials?
Well, the first major query submitted to the Gap Advisors repository asks exactly that fundamental question.
Right. The user asks, should this forward contract be designated as a fair value hedge or a cash flow hedge?
And the initial response to that query reveals a pretty interesting facet of the standard. Technically, under the IND-AS framework, the forward contract can be designated as a hedging instrument in either a cash flow hedge relationship or a fair value hedge relationship.
Wait, either one. The standard permits both avenues.
Yeah, both are technically permitted.
Well, if both are legally permitted, it feels like we were facing more of a philosophical divide rather than a strict mathematical rule. I mean, aren't we just picking our poison here?
It can feel that way at first glance, yeah.
Like, suppose I'm trying to lock in the cost of a future international vacation. A fair value hedge feels like I am buying a separate financial instrument whose value perfectly, inversely correlates with the fluctuating daily price of my airline ticket.
Right, you are hedging the changing value of the ticket itself.
Exactly. But a cash flow hedge feels like I'm simply setting aside a distinct, guaranteed pool of cash so that I know I have exactly enough to pay for the ticket on the day I fly, regardless of what the ticket is actually worth in the interim.
That is a really great analogy.
Thanks. I mean, it feels like I am isolating two entirely different types of risk. How do these two philosophies actually diverge in the context of our $1,000 payable?
Well, your analogy perfectly isolates the conceptual distinction. A fair value hedge is specifically constructed to protect against changes in the valuation of a recognized asset or liability.
Okay.
So in this scenario, the recognized liability is the trade payable that is already sitting on the company's balance sheet.
Hmm.
A fair value hedge acknowledges that the value of that specific liability is fluctuating, and it attempts to neutralize that fluctuation.
Whereas the cash flow hedge ignores the balance sheet value today and basically just looks forward to the actual moment the money leaves the bank account.
Precisely. A cash flow hedge protects against the variability of future cash flows. It targets the uncertainty of the ultimate settlement amount.
Okay, I see the difference.
And the reason both are technically permissible for a foreign currency payable is because, well, a foreign currency payable inherently generates both types of risk simultaneously.
Oh, that makes sense, because it generates fair value risks since its rupee equivalent changes daily.
Exactly.
And it generates cash flow risk because the ultimate amount of rupees you must hand over at settlement is technically unknown until the very end.
You nailed it. However, as the source text clarifies, while both are permitted, they are absolutely not equal in their practical application. One is vastly preferred over the other.
Okay, before we explore why one is preferred, I think we need to address the second query from the user, because it highlights a major psychological hurdle that I think a lot of people fall into.
The illusion of the static payable.
Yes. The user asks, if we choose a cash flow hedge, how do we calculate effectiveness and ineffectiveness? After all, the hedged item is just a foreign trade payable of $1,000.
Right.
That $1,000 doesn't change in fair value. Only the forward contract changes based on currency rates. So how do you measure that?
What's fascinating here is how strongly the human mind anchors to the nominal number printed on an invoice.
It really does.
The user sees $1,000 on day one, and they see $1,000 90 days later. And because the numeral itself does not change, the mind just automatically assumes the underlying economic value is static.
Right, because if I owe a supplier $1,000, I don't owe them $1,010 tomorrow. The obligation is completely fixed in its native currency.
Exactly.
So from the user's perspective, trying to calculate the changing fair value of a static rock seems impossible. I mean, you cannot measure a change that does not exist.
And this is exactly where we must introduce IND-AS 21 into our analysis.
Okay, the foreign exchange standard.
Yes. IND-AS 21 governs the effects of changes in foreign exchange rates, and the response from CA Manish C. Iyer meticulously deconstructs the user's premise here.
How so?
Because the assumption that the fair value of the trade payable does not change is fundamentally flawed within the context of Indian accounting standards.
So it does change?
Yes. While the US dollar amount is static, the fair value of that obligation expressed in the reporting entity's functional currency,
which is Indian rupees in this case.
right, Indian rupees, that value is in a constant state of flux every single day.
Because the financial statements are not some multi-currency document. They present a unified view of the company's financial health translated into a single measuring stick, which is the rupee.
Exactly. You have to translate it. IND-AS 21 classifies a foreign trade payable as a monetary item.
A monetary item.
Right. A monetary item is a unit of currency held or an asset or liability to be received or paid in a fixed or determinable number of units of currency. And the standard mandates that at the end of each reporting period, foreign currency monetary items must be translated using the closing rate.
Okay, let us clarify the mechanics of that translation for a second. If the financial year ends on March 31st, we are not looking at the historical exchange rate from back when the goods were purchased, right?
No, not at all.
We're taking the exact spot exchange rate at the close of business on March 31st and applying it to that $1,000 payable.
We are revaluing the liability based on the economic reality of that specific day.
Okay, so if the rupee has depreciated, say, from 60 to 62 against the dollar by March 31st,
Then the liability is no longer 60,000 rupees. It is 62,000 rupees.
wow. So the fair value of the trade payable has demonstrably changed on the books.
It absolutely has. Furthermore, IND-AS 21 requires that this change, this 2,000 rupee exchange difference, must be recognized immediately in the statement of profit and loss.
The P&L takes an immediate hit.
Immediately, yes.
So returning to the user's confusion about calculating hedge effectiveness, the user thought they were comparing a fluctuating forward contract against a static $1,000.
Right, which was the psychological trap.
But effectiveness is actually calculated by comparing the very real changes in the fair value of the forward contract, which is the hedging instrument, against the equally real changes in the fair value of the trade payable in INR terms.
Exactly. You're measuring the symmetry of two moving targets. If the liability increases by 2,000 rupees, does the forward contract asset increase by a commensurate amount?
That offset determines the effectiveness of the hedge.
You've got it. That's exactly how it works.
Okay, this brings us to the definitive recommendation in response 3 of the source text, which resolves our initial pick your poison dilemma from earlier.
Yes, the big reveal.
The response explicitly states that a cash flow hedge is not recommended in case of recognized asset or liability that is a monetary item for foreign currency risk.
Strong words. Not recommended.
Very strong. Instead, the source provides the exact journal entries specifically for a fair value hedge, assuming settlement on a gross basis.
Froggy.
So let us break down the mechanics of the fair value hedge, starting from day 1. If I sign a forward contract today to buy dollars in 3 months, but no money changes hands today, my instinct as an accountant is that there is no transaction to record. Does the standard require an initial journal entry?
Your instinct is totally correct. At initial recognition, there is no journal entry for the forward contract.
Wait, really? Why is that? I have entered into a legally binding agreement with a major financial institution. That seems like an event worthy of the ledger.
It is an event, definitely. But at the exact moment of inception, the fair value of that forward contract is zero.
Zero.
Yeah, zero. It is an executory contract at this stage. You have promised to purchase currency in the future, and the bank has promised to sell it. Because the forward rate you agreed upon is the prevailing market forward rate at that specific second, neither party possesses an advantageous position.
Ah, I see.
There is no intrinsic value to record until time passes and market rates begin to diverge from your contracted rate.
Okay, the scale starts perfectly balanced at 0, but let us move the timeline forward.
Let's do it.
Suppose we entered this 3-month contract in February. The maturity date is in May, but right in the middle, we cross that crucial March 31st reporting date.
The dreaded reporting date.
Exactly. The exchange rates have inevitably moved since February. The scale is no longer balanced. How do we account for this under the fair value hedge model?
Well, the source text provides 2 highly specific entries for the reporting date. I will read them, and then we can analyze the narrative they construct.
Sounds good.
So, the first entry. You debit foreign exchange gain or loss on trade payable, and you credit trade payable.
Okay, let's dissect that first entry. We are debiting the P&L with a loss, and we are crediting the trade payable.
Right.
And in accounting mechanics, crediting a liability increases it. So this entry tells us that the rupee has weakened since February.
Exactly. The company now owes more rupees to settle that same $1,000 debt. They are recognizing the loss mandated by IND-AS 21.
Man, if the company had not hedged, this would be a moment of significant distress.
Oh, absolutely. They would be reporting an unmanaged loss to their shareholders simply because of macroeconomic currency fluctuations completely outside their control.
But the second entry changes the narrative, right?
It does. The second entry is debit forward contract and credit foreign exchange gain or loss on forward.
Okay, so we debit the forward contract, which means we are increasing the value of that asset from its starting point of zero.
Right, it's an asset now.
The contract now holds intrinsic value because the market rate has moved in our favor relative to our locked-in rate.
Exactly.
And simultaneously, we credit the P&L with a foreign exchange gain on the forward contract.
And this is where, by analyzing the P&L now, the brilliance of the fair value hedge just becomes completely obvious.
Because they cancel out.
Yes.
Yeah.
The income statement absorbs a loss from the revaluation of the trade payable, but it simultaneously absorbs an offsetting gain from the revaluation of the forward contract.
That is beautiful. The net impact on the profit and loss statement for the financial year ending March 31st is effectively neutralized.
The volatility is completely contained, the liability expands, but the asset expands in tandem.
Yeah.
You successfully cross the March 31st threshold without alarming the investors at all.
Here's where it gets really interesting, though. Yeah, because crossing the reporting date is, at the end of the day, an accounting exercise. But in May, at the end of the 3 months, the actual cash must leave the bank account.
Reality sets in.
Exactly. It is time to settle both the payable and the forward contract. How does the theory translate into actual cash flows?
The settlement entries in the source text provide a fascinating look into the volatility of currency markets. The source lists 4 final entries. Let us examine the first 2, which occur immediately prior to the actual transfer of cash.
Okay, lay them on me.
First settlement entry: debit trade payable and credit foreign exchange gain or loss on trade payable.
Wait, debit the payable.
Yep. And the second settlement entry is debit foreign exchange gain or loss on forward and credit forward contract.
Hold on. These entries are the precise inverse of the entries we recorded on March 31st.
They are indeed.
We are now debiting the trade payable, which reduces the liability, and we are crediting a gain to the P&L. What does this tell us about the currency market between April 1st and May?
It indicates a complete market reversal.
A reversal?
Yeah. After weakening in March, the Indian rupee strengthened again against the US dollar by the settlement date in May.
So on March 31st, the payable had ballooned, forcing us to recognize a loss.
Right.
But by May, the payable shrank back down, requiring us to reduce the liability and recognize a gain.
Exactly. You must continually mark the liability to market up until the final moment of settlement.
That makes sense.
And because the forward contract is inextricably linked to this liability, its value must also be adjusted. That is reflected in the second settlement entry. You credit the forward contract, reducing its asset value, and you debit a corresponding loss to the P&L.
Once again, the gain on the payable offsets the loss on the forward contract.
Right.
The P&L remains protected during the final period, despite the market completely reversing its direction.
The hedge maintains its structural integrity until the very end. The values are now adjusted to reflect the exact spot rate on the day of settlement. Now the company must execute the transactions.
And the source text explicitly assumes settlement on a gross basis, right?
Yes, gross basis.
Okay, so gross settlement means we are not just exchanging a net difference with the bank. We are fulfilling the full terms of both obligations separately.
Correct.
What are the final 2 entries that reflect this?
Well, the final entries represent the actual physical movement of cash. The third entry is debit trade payable and credit bank.
Okay.
And the fourth entry is debit bank and credit forward contract.
Let us trace the cash here. The third entry is the payment to the supplier. The company sends the $1,000, debiting the trade payable to 0 and crediting the bank.
Right.
Because the rupee strengthened a bit since March, let's say it cost them 61,000 rupees at today's spot rate to acquire those dollars. They pay 61,000 rupees out of their account.
However, their original intent back in February was to lock in the cost at exactly 60,000 rupees.
Right. They didn't want to pay 61.
No, they didn't. They have currently paid in excess of 1,000 rupees, but this is resolved by the fourth entry.
The fourth entry is the settlement with the bank on the forward contract. The company effectively says, hey, we contracted to buy dollars at 60. The spot market forced us to buy them at 61 to pay our supplier. You owe us the difference based on our contract.
Exactly. And the bank deposits 1,000 rupees into the company's account. This debits the bank, bringing cash in, and credits the forward contract asset down to 0.
When you aggregate the cash flows, the mechanism is just flawless. The company paid the supplier 61,000 rupees. The bank paid the company 1,000 rupees. The net cash outflow is exactly 60,000 rupees.
The original objective is achieved.
The cost was locked in. And through the mechanics of the fair value hedge, this was accomplished without subjecting the profit and loss statement to the wild, erratic swings of the currency market across different reporting periods.
It perfectly aligns the economic reality of the risk management strategy with the accounting presentation.
Yeah.
It's really elegant when you map it out like that.
It really is. But I want to loop back to the critical warning from response 3.
Oh, the cash flow hedge warning.
Yeah. The user asked if they could designate this as a cash flow hedge. And the Gap advisor's response stated firmly that a cash flow hedge is, quote, not recommended.
Right.
If we connect this to the bigger picture, why is it so strongly discouraged? I mean, if the ultimate goal is to protect a future cash outflow of 60,000 rupees, why is the model explicitly named for cash flows considered the wrong tool?
That is a great question. If we connect this to the bigger picture, we must analyze the architectural interaction between two distinct standards.
Okay, which ones?
IND AS 109, which dictates hedge accounting, and IND AS 21, which dictates foreign exchange translation.
Right.
The conflict arises in a specific section of the balance sheet called Other Comprehensive Income, or OCI.
Ah, OCI. How does the cash flow hedge utilize OCI?
Well, the fundamental mechanism of a cash flow hedge is deferral. If you designate a derivative as a cash flow hedge, you do not recognize the gains or losses from its fair value fluctuations immediately in the P&L.
You don't.
No, the standard argues that because the hedged cash flow hasn't actually happened yet, the offsetting gain or loss shouldn't impact the current period's profit. Instead, you park those fluctuations in OCI.
Okay, so OCI acts as a holding pen. It keeps the unrealized gains and losses from the derivative separated from the operational P&L until the actual transaction occurs. In a vacuum, I guess that sounds logical?
In a vacuum, it is totally logical.
Yeah.
But it does not exist in a vacuum. It exists alongside IND AS 21.
Right.
Recall our earlier discussion. What does IND AS 21 mandate we do with the foreign currency trade payable on March 31st?
IND AS 21 requires us to revalue that monetary item at the closing rate. And critically, it requires us to run that resulting gain or loss directly through the P&L immediately.
And there lies the systemic failure of using a cash flow hedge in this specific scenario.
Oh, I see it now.
Yeah. IND AS 21 forces the loss from the payable directly into the P&L. Your liability increases and your profit decreases. However, because you elected to use a cash flow hedge, the offsetting gain from your forward contract is mandated by IND AS 109 to be parked in OCI.
The symmetry is completely broken.
Completely broken.
The P&L reflects massive unmitigated currency losses, making the company appear highly volatile to investors, while the gains that prove the company is actually fully protected are just hidden away in the equity section of the balance sheet under OCI.
It creates an entirely false narrative of risk.
That is a disaster.
It is. And to correct this, the standard requires a really complex process of reclassification. You must continuously track the amounts deferred in OCI and systematically recycle them out of OCI and into the P&L in the exact same periods that the payables fluctuations impact the P&L.
You are creating an enormous, convoluted administrative burden.
Huge burden.
You are forcing the offsetting gain to take a massive detour through OCI, only to drag it right back into the P&L to achieve the exact same net result that a fair value hedge achieves automatically.
It is basically accounting masochism.
Wow.
Yeah. The fair value hedge naturally synchronizes with IND AS 21. Because IND AS 21 forces the monetary items changes into the P&L, the fair value hedge allows the derivatives changes to also flow directly into the P&L.
The offset happens immediately.
Immediately, cleanly, and without the necessity of OCI routing.
This analysis just perfectly illustrates the utility of the Gap Advisor's repository for practitioners.
It really does.
I mean, imagine an auditor reviewing the financials of a mid-sized corporation.
Sure.
The corporate finance team, understanding they are hedging a future cash payment, naturally assumes they should use a cash flow hedge.
It sounds right in theory.
Right. So they construct this labyrinth of OCI deferrals and reclassifications. They might even be calculating effectiveness incorrectly because they are still comparing the derivative against a static dollar amount rather than the revalued rupee amount.
And then the auditor is tasked with untangling this web. They must explain to the client why their conceptually logical assumption is structurally incorrect under the framework.
Which is an incredibly tough conversation to have without backup.
Exactly.
But the response provided by CA Manish C. Iyer equips the auditor with the precise documentation needed for that conversation. It is not merely an auditor's opinion anymore.
Right. It is a definitive interpretation showing why the fair value approach is the recommended, cleaner path for recognized monetary items.
It transforms a potential dispute over accounting methodology into a clear educational correction supported by expert consensus.
And it reduces friction during the audit process. Ultimately, it results in financial statements that present a truer, less complicated picture of the entity's risk management activities to the end user.
Well, we have deconstructed a significant amount of technical architecture today.
We covered a lot of ground.
We started with a simple invoice for $1,000 and explored the mechanisms of fair value hedges, the translation requirements of IND AS 21, the complexities of gross settlement, and the hidden pitfalls of other comprehensive income.
It demonstrates how a routine operational decision, like, purchasing a forward contract to protect a margin, requires a deep structural understanding of how different accounting standards interact.
It really does. As we conclude this analysis, I want to leave you, the listener, with a final thought to consider regarding the broader economic landscape.
Let's hear it.
We have spent an hour dissecting the accounting required to protect a single $1,000 transaction for 3 months. Extrapolate that effort across the global economy.
Oh, wow.
Consider the massive multinational corporations managing supply chains that span dozens of currencies, processing billions of dollars in cross-border transactions daily.
It's almost unfathomable.
When we look at their financial statements and observe smooth, predictable profit margins year over year, how much of that perceived stability is a reflection of actual operational dominance, and how much is just the result of brilliant, invisible hedge accounting, silently absorbing the massive shocks of global currency wars before they ever reach the P&L?
That is a fascinating point. The financial statements we read are heavily engineered structures designed to filter out the chaos of the markets. Hedge counting is perhaps the most critical filter they possess.
Absolutely. Well, we want to thank all of you for dedicating your time to learning with us today. Understanding the depths of these standards requires patience, but the clarity it provides is invaluable.
It is truly worth the effort.
If you found today's deep dive useful, please take a moment to follow or subscribe to the Gap Advisors NDS Clinic podcasts. You can find us on Spotify, on Amazon Music, and on YouTube, whichever platform you prefer to use for your technical listening.
Yes, subscribing ensures you are notified whenever we unpack another critical issue from the repository.
The application of Indian accounting standards is an ongoing dialogue, and shared knowledge elevates the entire profession. So we also request that you share this deep dive among your contacts, your colleagues, and your audit and finance teams.
Please do.
Send it to anyone who might benefit from a clear understanding of how to apply Indian accounting standards in practice. And of course, remember to visit giskadvisors.com. Register for free to access their incredible issue repository and submit your own queries for direct expert responses.
It's an indispensable tool.
It really is. Until our next analysis, keep questioning the mechanics behind the numbers, and we will see you on the next deep dive.